Hi everyone, this is Sheikh and you are watching 0 to Million episode 5. In this episode, we are going to discuss how one idea changed the entire history and created a stock market. How did the stock market actually started? Imagine it's there 1400. There are no companies like Apple, Samsung, Tesla or Amazon or even Reliance. Business is simple. A farmer owns a farm, a blacksmith owns his workshop, a merchant owns his own ship. If someone wanted to start a business, they had only three choices: use their own money, borrow money, or find a wealthy partner. But there was one huge problem. Some businesses needed far more money than one person could afford. Imagine you wanted to build a huge trading ship and sail across the world. A single ship cost a fortune. Very few people had that kind of money. So how could anyone build something that expensive? The Dutch came up with an idea that changed the history of stock market forever. In fact, they built the first stock market. In the year 1602, the Dutch East India Company, also known as the VOC, wanted to send a large fleet of ships around the world. They traded spices, silk, porcelain, gold, and many other valuable goods. But building dozens of ships was incredibly expensive. Instead of asking one rich person for the money, they asked thousands of ordinary people, private citizens, who want to invest money in that company. In return, they received a small ownership called share. If the company made money, the investors shared the profits. If the company lost money, the investors shared the losses too. This allowed the VOC to grow much faster than ever before. Soon people wanted to buy and sell these shares, but where? The Dutch created a marketplace where investors could trade shares with each other. This became the Amsterdam Stock Exchange, one of the world's first stock exchanges. The stock market was born. Over time, many other companies copied this idea. Instead of depending on one rich investor, they could raise money from thousands of people. Today, we call this process an IPO or initial public offering. When a private company goes public, anyone can buy a small piece of that company or that business. You become a part owner. Let's imagine your friend sells samosas. His shop is doing well, but he wants to expand the business. He needs money to open new stores. He could borrow money from a bank or he could sell part of his business to investors. If investors believe his idea, they'll invest. Now he has enough money to grow much faster with investments. With that money, he buys better equipment, he improves recipes, he works on R&D, he creates attractive packaging, he opens up new stores. More customers start buying his samosas. His business grows. As profit increases, more investors want to own the company. Demand for the shares increases and the stock price usually goes up. But things don't go always according to the plan. Maybe customers don't like the new product. Maybe competitors make better samosas. Maybe the cost goes up. Or maybe the economy slows down. If investors lose confidence, they start selling their shares. More sellers than buyers means stock price falls. This is why stock prices move every day. They're influenced by many things other than just the business. Company profits, new products, competition, interest rates, government policies, global events, and a lot of other things as well. And most importantly, what investors believe will happen in the future. So, here is something many beginners misunderstand. A stock price doesn't always reflect what a company is worth today. If it reflects what people think the company will be tomorrow. Sometimes those expectations are correct, sometimes they're completely wrong. That's why bubbles happen. When everyone rushes to buy because of the excitement, prices can rise far above reality and eventually they can crash. This is why legendary investors like Warren Buffett focus on long term investing. They are not trying to predict tomorrow's price, they are buying great businesses and letting time do that work. As the saying goes, investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. This was said by Paul Samuelson. Today, because of technology and the internet, anyone can invest. You don't need to be rich. You can own small pieces of some company with just few hundred rupees. The stock market isn't a place to get rich overnight. It's a tool to slowly build wealth over many years, and that's how stock market actually works. There is a lot more to stock market than just this. You'll know in the coming videos. Please like and comment and subscribe. Please share this video with your friends. Encourage me for better content.